Hello, and welcome to the monthly Commonwealth Market Update. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. The word for July was bounce. We saw bounce backs in a number of different areas. The U.S. markets and the developed markets bounced back after a difficult June, regaining almost all of their losses. Not only that, the economy as a whole did much better in the second quarter and for the first half of the year than was expected. Even though the second quarter numbers came in a little below expectations at 2.3%, we still saw the first quarter revised up substantially from minus 0.2% to plus 0.6%. So the first half of the year was better than expected. Not only that, the fundamentals in the form of job growth continued very strong. What we saw was a job gain of 223,000 and a reduction of the unemployment rate down to 5.3%. Those are both very strong numbers and show that the recovery, especially in employment, continues. Not only that, we've got some other good news as well. We have the number of jobs out there going to an all-time high. Adjusted for the labor force, it's the strongest labor demand since 2000. And we saw the jobless claims, the unemployment claims, come in at a 40-plus year low, the lowest level since the 1970s. Obviously, things aren't perfect. Wage growth in particular is an area of concern, but nonetheless, the fundamentals remain very strong. The problem is, though, that people did get spooked by the turbulence. We had the Greek crisis. We had the Chinese market meltdown. We had the New York Stock Exchange shut down. Any one of those could have caused a lack of confidence, and in fact, that's exactly what happened. We saw consumer confidence pull back a bit. We saw retail sales pull back a bit. They were flat last month, which we were expecting growth. That's not a good thing. But the reality is that we continue to see consumers earn more, and the fact that they're not spending represents a short-term problem and a long-term benefit. Because that's the reality of what's going on here. We have short-term damage, we have long-term stability. And one way of looking at the turbulence that we've weathered here is to consider it as a stress test. Back in 2011, the Greek crisis back then brought the world financial markets pretty much to their knees. This time, nothing like that. You could legitimately expect a Chinese market crash to pull markets down worldwide. It happened a little, but not much. Any one of these items could have legitimately caused a serious pullback and serious concern, and the fact that they didn't actually is a very real stress test that illustrates how strong the fundamentals are right now. That said, we've got headwinds. We can expect to see slower growth, but the fundamentals remain strong, and the longer the headwinds slow spending, the more saving there is, and the better the foundation for growth going forward. So that's where we are. We're seeing some recovery from turbulence. We're seeing risks recede, and I expect to see things continue to do fairly well. With that, I'll leave you, and I hope you have a great August.